Hey everybody, it's Matt Bowles. Welcome to the webinar. We've got a super important event for you tonight. So I want to congratulate everybody that has decided to show up live. This event is 100% live, so you are going to be able to ask your questions at the end of the presentation. So you can also, though, chat with us as we go through the presentation, and you should have a chat box on the right-hand side of your screen. And there you can just chat and communicate with us throughout the webinar. And you can also then at the end type your questions into there and we will read them out. If you want to try that out right now, go ahead and type in, let me know where you are tuning in from tonight. You can also let me know if this is your first Maverick event that you've been to before, or if you've been with us on previous webinars. For people that are brand new to Maverick, we are here to help you to buy turnkey rental properties in out-of-state markets that are either brand new or fully renovated. They have tenants and local property management already in place, so you can own them from anywhere without having to be the landlord or the rehabber. And the other thing that we do is we try to provide you free, high-value education that can support and help you in your real estate investing journey, and to introduce you to top professionals that you are going to want to have in your ecosystem as you move along on your real estate journey. And that is what brings us to tonight's webinar. And I am super excited for this. It's really timely. It's really important. And I'm excited to introduce all of you to Nicole Green, who has over a decade of experience in the tax world. She holds a federal license as an enrolled agent tax practitioner. She can advise, represent, prepare tax returns for individuals, partnerships, corporations, and any other entity with tax reporting requirements. Her knowledge and tax advice has been recognized in numerous publications, including the Wall Street Journal and many others that you would know. Nicole, welcome to the webinar.
Why, thank you. Thank you so much for having me. I enjoy talking about taxes, so this is kind of fun stuff. And Trump's been doing a lot. So today's webinars, we got a lot to talk about.
Well, I am going to let you take it away. We appreciate your expertise tonight, and I am going to be taking out my notepad here to take notes, and hopefully everybody else has already done that as well. And then, folks, again, Q&A we're going to do at the end, but if you want to communicate with us throughout the webinar, use the chat box for that. Nicole, the floor is all yours.
Perfect. Thank you guys so much for coming to the webinar. We're going to get into the big changes that have happened with Trump's big, beautiful bill that he has done. I mean, there's a lot of things going on right now. The government is, shut down. And so that makes it a little difficult for me when we're filing our tax returns here, being on the last extension deadline. But, we're pushing through as always. And we've got a lot of big changes coming in 2025 from the big, beautiful bill. Before I got into taxes, I was an educator. I currently work here at Robert Hall and Associates, but I say that meaning that I am totally free to take questions. And so as I'm going on, please add your questions to it, because again, I used to be an educator. I love questions. And one thing that Robert Hall and Associate really strives for, Robert Hall himself used to be an educator too. That's kind of why we get along. But we really strive to educate people. One of those great things that we do to help educate people is to offer free consultations. I put the QR code here. You can also get my email address on the screen. If you want to sign up for a free consultation, just sometimes to ask questions or to see what's going on in your tax return. Several times I get people that will show me their tax returns and they're like, oh my God, I think my guy is like awful. And I'm like, no, your person's not doing anything crazy. You just maybe don't communicate well with them, or it's the other way around. I'm like, your person's very conservative or whatever. But it's nice sometimes for people to get a second opinion for free, because I know talking to an accountant, a lawyer, a doctor, usually it's people we charge, and with this is completely free. And so it's a really great opportunity for people. Okay, I want to just let everybody know I'm licensed by the federal government. This is tax advice. I'm nothing but a little education. All right, so the 10 things that have happened with Trump's big, beautiful bill, there's like a lot of changes that have actually happened with it, but some of the big ones that we're going to talk about, 10 big ones. The first, we're going to talk about how he extended the cuts that he already had previously had made. So when a president affects the tax code, it's always going to be temporary, or it's usually going to be temporary, and things phase out or they completely end. And a lot of the things that he did in his first term were phasing out or ending them. We saw this really a lot with depreciation. That was one of the big ones, depreciation. And so depreciation, he made it so that you could take 100% bonus depreciation, and in his first term, and that started to phase out, so people were not able to take 100% anymore. It was like, went from 80 to 100 to 80 to 60 to 40, and so now he brought it back, all of his original things that were done in the 2017 TCJA Act, and that has also been extended indefinitely. And so that is actually like a really good, really great thing that has been able to be done. And so we don't see those things expiring anymore. Another thing that I think is actually really kind of cool to do is he created these child tax. He increased the child tax credit. The child tax credit has increased from $2,000 to $2,200. Increasing the child tax credit is something that needs to happen because inflation is happening, and the child tax credit is a really nice thing for people to get. Remember, credits are sometimes better than deduction because that's dollar for dollar. And so if your tax is $5,000 and you have a $2,000 credit, you now only have to pay $3,000. And so deductions take away your taxable income, while a credit will reduce the actual tax that you have. And so that's really, really nice that we can have this credit going up, especially as inflation goes up. I tell my boss, inflation goes up every year, so I need to get a raise every year. He doesn't always agree. But we get this credit increase, which is really, really great for families. Salt tax deductions. Now, salt taxes are state and local taxes, and this includes the taxes you pay to the state income taxes. This includes property tax. This includes sales tax. If you pay local tax, like if you live in New York City, if you live in LA, there's local taxes that you have to pay. Stuff in Oregon, like there's a bunch of local taxes. All of those combined are a deduction, and that deduction has capped out at $10,000. And so if you live in a high tax state, that $10,000 is quite a low number. Me living in California, me living in Southern California, is really, really painful because my property tax is more than $10,000. So like I pay a lot of state and local taxes, and it capping at $10,000 really, really sucked. And now that has increased to $40,000. This is absolutely amazing. So this can literally be a $30,000 increase of deductions for people, which really is quite a bit, especially if you're at a pretty high tax rate. If you're paying 10% to the state and 25 to the feds, this can be a significant tax savings for you. There is a limit, and that is for families under $500,000. It's not single persons, it's the tax return. Your AGI needs to be under $500,000. If you're under $500,000, you're now able to get up to a $40,000 deduction. And so this is a really, really nice one. This is going to last for 5 years. After the 5 years from 2025, and so in 2030, that will be the last year, and then I'll go back down to that $10,000 cap, which really, really sucked. Really, really, really sucked. Okay, this one was talked about quite a bit with people, and it got, some people got a little confused about it. We've got tips and overtime. They're two separate things, obviously, and there's going to be a $25,000 deduction. So if you earn tips up to $25,000 of those tips, and you, the worker, make less than $150,000, that $25,000 will not be subject to income tax. And so not your payroll and stuff like that, specifically the tips. While everything normally that people have coming in is subject to income tax, and if your tips are inside your payroll, it will still be subject to payroll taxes. It will not be subject to income tax. So essentially, the first $25,000 of tips is now going to be income free. And this is for people that are making less than $150,000. People that make over 150, you do not get any of your tips. You do not get any of your tips tax free. For overtime is going to be capped at $25,000, and this is going to be for joint filers and individual filers as well. But instead of it being $25,000 per person like tips, it is going to be for the joint return. Okay, and so that's essentially, if both people are making overtime, it's going to be $12,500 for each person. If you're a single filer, or you're a head of household, or qualified widower, then you're going to be able to take that full $25,000, but per return, the max is going to be $25,000 of overtime that is not going to be subject to income tax. It will be subject to payroll tax, but not income tax. And that's actually very, very nice, because a lot of times people will get their checks and they'll say like, oh my God, my overtime, a lot of it went to pay taxes. And yes, it's because how payroll is done, but that will actually, if you've already had that happen, that will get refunded back to you. And so that one's also very, very nice for people. The next one is the no income tax on Social Security. And so basically what happens is Social Security is taxed either in three different brackets. We're going to have either 0% of your Social Security is taxed, 50% of your Social Security is taxed, or 80% of your Social Security is taxed. And this all is determined by how much other income you have. What Trump has done is he has gone through and made a $6,000 deduction to that Social Security. So the first $6,000 of your Social Security is not going to be taxed. And so what this means is a lot of people that are at the 50% are now going to drop down to the 0%. And a lot of people that are at 80% are going to drop down to 50%. And so it really kind of helps. And then the people that are just like deep inside the 80%, yes, you're not going to have 50% of your Social Security not taxed, but you will have $6,000 of Social Security that won't be taxed. And so this is really, really helpful. Again, there is going to be an income cap. It is going to be for people that are earning a total of either $75,000 if you're single, or head of household, or qualified widower, and then $150 if you're married filing joint. And so this really, really helps a lot of people. About 88% of the people receiving Social Security is going to change which bracket they're in. If they're going to be in the 80, in the 50, or in the 0% of your Social Security being taxed. And so that one's really, really nice. Auto loan deduction interest. This one is like a surprise, but it's actually quite helpful for people that have gotten cars in the last few years, because your auto loan interest is going to be able to be deducted. And this is going to be only for U.S. assembled vehicles. And now there's a big bunch of controversy about, is it assembled in the U.S. and what's been happening. We saw this a lot when they were talking about the energy credits, right? And so a lot of automakers have figured out ways to get things assembled here in the United States, even though it's like pre-assembled abroad, but a lot of it's coming back here in the US. And so what this does is it adds the interest deduction to your itemized deductions. Normally in your itemized deductions, you've got your SALT taxes, which normally are capped at $10,000. You have your but now instead of 10,000, it's going to be 48,000 for 2025. You have your charitable deductions. You have medical deductions. Remember, your first 7.5% of medical expenses is not deductible. Anything after 7.5% of your AGI is deductible. And then you also have interest, your mortgage interest. And now you can also have your auto loan interest in there. And so that really helps because you can deduct up to $10,000 of auto loan interest. Normally, people that don't own property, they don't own their primary residence, really don't itemize anymore because back in 2017, Trump increased the standard deduction, and so more people just fall into the standard deduction because it's either or, right? Are you going to itemize or are you going to take the standard deduction? Well, you can pick. We just always pick whatever is the highest. And so if the standard deduction has increased, a lot more people that's going to be higher for. But now because we're able to add more things, you have the increase in your SALT taxes, you have mortgage interest, you have also now auto loan interest up to $10,000. A lot more people are going to be able to itemize and have this larger deduction going to them. And so this is really, really nice. Again, this one phases out for people for returns, married filing joint returns for people that have $200,000, single, head of household and qualified widowers at $100,000. That's where it starts to phase out. And remember, phase out doesn't mean it's going to completely cut off if you're single and you're making $100,000. It's just going to stagger out as your income is. So one of the things that I talked about earlier that was extended with the TCJ Act that happened in 2017 is bonus depreciation. 100% bonus depreciation. This is absolutely wonderful. I'm going to explain depreciation just really quickly here. Depreciation is when you take the value of the asset, whatever you purchased it for, and then you go ahead and spread that over a certain amount of time. This is not determined by your accountant. This is not determined by you. It's not determined by a county assessor. This is determined by GAAP, general accepted accounting principles. And so what things are spread over is already predetermined. Cars are spread over 5 years. Houses are residential properties are spread over 27 and a half years. Blah, 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 and so forth. And to be able to take 100% of that means that you can have that item and not spread it over the years. You're able to take 100% of it in the first year. And so I have some clients that do construction and they're buying vehicles every year. And that's a really nice deduction for them. They buy vehicles for the people on the team. They need new vehicles because, they have a construction company. And so now we're able to take that full vehicle amount, whatever they purchased it for, regardless if it was finance, and we're able to take that deduction all in 1 year. This is really nice for people that also are real estate professionals and have properties. If you have a property and you want to do a cost segregation study, you can go ahead and a cost segregation study will go and itemize all of the things in the house. And so windows are done over 15 years, and obviously the construction of the house is 27 and a half years, but maybe the carpet is 5 years, whatever it may be. They go and itemize these things. And so now some of these things are eligible for bonus depreciation. And so if you have this $1 million house that you purchased, you could go ahead with the cost seg, have $400,000 of depreciation available to you in the first year. This normally you only, because we're spreading it over 27 and a half, you don't have so much depreciation. And while rentals always show a loss, or mostly always show a loss because of depreciation. Now you have all this depreciation that can go against your spouse's income. It can go against any capital gains you have, all of this. And so it makes it for a really great opportunity to increase your real estate portfolio. What ends up happening is people do these cost segregation studies and they end up having, 1, 2, 3 years of no tax. You take that tax savings, you don't go to Tahiti, but you take that tax savings and you invest it into another rental, and then you do a cost seg on that rental, and you keep going forward. And so you literally can expand your real estate portfolio by 3-fold, 4-fold in 5-10 years. It's a really, really, really nice tool. It's not something I recommend if you're just doing it to lower your tax, because you're just taking your depreciation that you would have had and you're moving it forward. But it's a really, really great benefit if you are thinking about growing. If you have a growth mindset, it's something that could be absolutely crazy advantageous. Now, if we're not itemizing, you don't really get to count any charitable deductions. During COVID, you got to count up to $300 of charitable deductions, regardless if you itemized or if you took the standard deduction. And now they kind of brought that back and increased it. You're going to be able to take up to $1,000 if you're single, or $2,000 if you're joint. So it's really $1,000 per person, whether you're taking the standard deduction or if you're itemizing an additional bit there. If you're already itemizing, you're already counting your charitable deductions, and so that one's kind of already a wash. But if you're taking the standard deduction, you just basically increase the standard deduction by $1,000 for single filers and $2,000 for joint filers. So that one's really, really nice. This one's a very cool one. I think this one was a little give me to like the Democrats. What was created is these Trump accounts. That's kind of the nickname that they coined them. And essentially what they did is, or what they're doing is, they are going to seed retirement accounts for children, $1,000 for anybody that is born in 2025 all the way up to 2028. They basically give these retirement accounts to the kids that are born in this time, and these retirement accounts will grow and grow and grow. People think like, what is $1,000? That's actually not going to do a lot. That's actually very much untrue, because with retirement accounts, it's all about compound interest, compound values, and it's all about the time that it is able to sit. And so if you put $1,000 in and that thing sits for 65 years, when it actually comes to pull out, it's going to be quite a bit more. My parents, I ended up working a little bit when I was much, much younger, and my parents put in, I think, roughly $12,000 or something around there when I was quite a bit younger. And currently today, that retirement account that started at $12,000 is over 6 figures, because it hasn't been touched. It's just been sitting there growing, and then all that growth is reinvested, and the reinvestment grows right into that, and it just keeps growing. And so that is I'm not super young, but I'm not retired age yet either. But $12,000 turning into 6 figures is pretty darn amazing. So this is going to be quite helpful, and I think really help out the Social Security, because Social Security is dying. And so this is going to help a lot of people have other bits of investment, because I don't know who can live on Social Security anyways. So we're really excited. Oh, I forgot to mention, these accounts are tax deferred, right? So this is really helpful for people growing for our future, kids. We've got some vehicle credits that are ending. This has been quite controversial, but it is actually happening. So EV credits have already ended. So if you haven't purchased an EV, that is completely over. The EV credits for cars and EV products had to be put into service September of 2025, so last month. Solar credits are going to start ending in the end of the first quarter or second quarter of 2026. It hasn't been fully determined yet, but solar and wind credits will end 2026. So those EV credits were $7,000 roughly, depending on your situation. A lot of retirement accounts, a lot of dealerships were giving people the EV credit and then reducing, like they would take the EV credit and reduce the price of the car. That was actually, if you were eligible for the EV credit, that was the best way to do it, because a lot of people were doing these EV credits and then they weren't able to use them, and they're not refundable, and they're not you could not carry them over, or your AGI was too high, and so they didn't qualify for them. And so it was really great. I always tell people, if you had the opportunity to have the EV credit, give it to the dealer. You get your $7,000 that way, as opposed to worrying about it on the back end. Solar credits at 30% of what you purchase for solar or wind, and those ones are ending in the first and second quarter of 2026, but it's all straight value of whatever you have purchased and put into service. Okay, we've got some highlights of a few things that I want to just kind of take note of, because, you know, there are not big things, but there are definitely going to be some pretty good things. So permanently, not a lot of people already know about this. This is something that changed a long time ago, but before you were able to have deductions if you were in the service industry, if you're a firefighter, if you were a teacher, a nurse, a police officer, etc. And you're able to have deductions, employer deductions, business deductions, even though you were W-2. They were miscellaneous itemized deductions. And so those have permanently been removed. They were removed a long time ago, and they were re-removed again with the 2017 TCJ Act, and now they've permanently been removed. It's basically indefinitely until some other president takes them and puts them back in, whatever. But they're completely gone, except for educators. And this one hasn't been fully talked about because this one is not fully fleshed out. And this is going to be effective for 2026. But educators, including coaches, including PE instructors, and including educators not in the classroom. This one's pretty great because it never used to be so wide, but all people dealing with education, PE, personal coaches, administrators, all of those are able to have these itemized deductions. And for educators in the past, there was a $300 cap. That cap is actually going to be expanded in an unlimited, technically, but not technically, because there's no way you're going to let people go in there and fully just deduct absolutely everything. So there is going to be some sort of, whether it's going to be a percentage or it's going to be a limitation on specific items, but that has not been fully fleshed out yet. That will come out later, because this, again, is going to be a 2026 thing, and the IRS says they need time to give guidance and clarity on how that deduction is going going to be allowed. But it is a really, really nice thing that educators, because a lot of educators obviously spend more than $300, and they obviously aren't getting all of their things for $300, but they do buy supplies for the classrooms, supplies for their kids, and things like that. And so them getting this deduction is going to be really helpful, that at least they won't get taxed on what they're spending. And it being for non-people, that not just people in the classroom, is really, really nice, because, you know, they do more than that in education. Okay, I rattled off a lot of the different changes, 10 big changes that we have. The educator one is just one of those sweet ones because, again, as I said, I used to be in education, but I definitely did want to open it up if people had some questions. I'm here.
Amazing. Thank you, Nicole. And folks, if you want to type your questions into the chat box now, we will read them out and you can get them answered by Nicole live here. While folks are typing those in, Nicole, can you reiterate the offer for this free consultation that you are offering, which I want to encourage everybody to take this offer, folks, because it's free. But can you explain how they can register for that and what they get?
So I love talking about tax. I don't mind talking about tax. All of my colleagues, we talk about tax all the time. When people find out I'm an accountant, they're like, I have a question. And I would sit there in the grocery store and talk with them. But a lot of times you need to get personal, and I need to see what's on your return, because before I can give you like an actual true answer. And so that's one of the reasons why we offer these free 30-minute consultations with an advisor, so that you can understand, hey, I have some questions, or I just want somebody to review my tax return. And we're able to, we'll say, like, can you please give us your tax return so we can see what's going on, so we can give you actual answers. Like, am I able to do a cost seg? I can give you that answer. Is it going to be a benefit to me? Like, because sometimes cost segs, while they're great, maybe you won't qualify, or it's actually not going to be a benefit to you. The thing's not too much, like whatever. I am now able to give you like real actionable steps, because when I look at the tax return, it's really easy for me.
All right, folks, if you have any questions, drop them into the chat box. Now is your moment to get those answered live. For anybody that is watching this on the recording and the replay, there you have Nicole's email address, so you can send your question to her directly, or, as I would recommend, sign up for this free consultation, because then you can also have a much more individualized discussion as well, and take some of these general things and ask those more individualized questions about how they apply to your situation and all of that. So would encourage everybody to take Nicole up on that offer. I am not seeing any questions coming into the chat, folks. So we may have answered all of them here. You may be signing up for your free consultation. But if there are no questions in the chat box, then Nicole, I want to thank you so much for being here tonight. This was fantastic.
You're so welcome. I love doing these things. It's been absolutely fun. And if anybody is worrying about their refund or filing right now, even though the government is shut down, you still need to file and you still need to pay on time. And your refunds are just going to be extremely delayed, because nothing's getting processed. Yay!
All right, folks. I want to thank everybody for being here tonight. Once again, please take down Nicole's email and register for this free consultation, where you can get more of your detailed, individualized follow-up questions answered. Nicole, thank you so much. This was fantastic.
You're very welcome. You guys have a wonderful evening.
All right. Good night, everybody.
Bye-bye.